Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Thick.
I've been a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
All right. Good morning, everyone. Welcome to this Wednesday edition of Benzinga's PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Thick with you this morning. We've got a lot to discuss. We have earnings. We want to talk about this Walmart deal with Flipkart. We'll talk about the reaction, if there was one. We'll break that down to the Trump's announcement of the Iran nuclear accord yesterday, the speech he gave at around 2:30. And then we are going to be joined by two guests today. First up at 8:35, Gil Morales. He is the author of the Gilmo Report and the managing director at MoKa Investors. And then at 9, we're going to be joined by an old friend of Joel and Dennis's, Robert McLister, a Canadian mortgage expert. He's the founder of a site called RateSpy.com. He'll join the show at 9 to break down the Canadian markets for us when he does that. Joel, what's happening this morning in the S&Ps?
We are in the green by $9.50, 79.75. Your pre-market high is right in between your 7 and 11-day high. So getting back to the top of that trading range, very important to get into the 26.90 handle today. Crude all over the map yesterday, now trading up $1.90 at 70.95. Big range yesterday, and here we are right back after that drop into the 67 handle. Gold basically flat, down a buck here at 13.1280. Silver up 4 pennies at 16.51. And Bitcoin, that's Bitcoin futures, clinging to the $9,000 level, up $75 at 9,295. Good morning, Dennis. How you doing on this Wednesday morning?
Pretty good. What's going on?
What's going on? Got 1,500 yards in this morning, so I'm feeling good. I'm feeling
Holy
pumped.
cow. What time do you get up to do that?
I got up late today. I got up at 5:35.
Do you have to use an alarm at that time, or does your body just naturally get up because you're on all that adrenaline from all this swimming all the time?
I hate to say it, but I wake up on my own.
Look at this guy. How old are you now?
I'm old, man. I'm old.
You're not that old. What are you, 53?
54.
54, and look at this swimming and stuff you can do. Man, I hope I'm not that healthy. I'm giving you a compliment here, buddy. I don't give you a lot of compliments, but impressive at 54 years old to be able to swim 1,500 yards. I don't know if I could swim 100 yards.
Yeah. We'll get you in Spencer when you guys get back in town. I want to give Spencer some swim lessons. But I guess the big story of the day here is Walmart. Spencer, why don't you give us the news?
Right. This has been rumored for a while. They were fighting with Amazon here to get in on this Flipkart deal. Well, now Walmart has announced they're investing $16 billion for a 77% stake of the Amazon of India. And they did say that the deal, if it closed this quarter, they would see some negative impacts to the fiscal year EPS next year and the following year. But that's short-term pain for long-term gain in Walmart.
A lot of short-term pain. This thing just hit 81.66. We're talking now 82.14, so a little bit off those lows. This takes out the key support of 85. This level had been holding here for 2 months. It is now gone. You're through that level. I wonder if this is washout day. You think this is washout day for Walmart here? We were talking on the pre show that I don't know if I'm jumping in here right off the hop. I want to see how it washes out, but maybe, you get down $3-4 here today, which is what we're down right now. Maybe you wash everybody out. Everybody who's leaning on that support, say, I got to get out of here. People play the breakdown. Could it be a fake down? Or is this is enough that, this is in deep trouble now? Because technically this looks like hell.
Technically, it looks like hell. Technically, let's take a look at the daily chart first, Spencer. Just a plop and then a long consolidation, very long consolidation, and now you're breaking through. Couple possible trade scenarios. I'll run them through you. First of all, someone is making a stand here around the $82 level. Your pre-market low is 81.71. That's held up over the last three brackets. So buyers right now at 81.70 to 82 even. I could give my old standard deviation move. Walmart trading down $4. It is trading some good volume. Yeah, it's a big move. If you're short, what better opportunity are you going to get to cover? With news like this. The only thing is
the news, just to interrupt you, that the news like this, bad. But really, the news is good news long run, is it not? I mean, a Flipkart business, Amazon wanted it, Walmart wins the bidding war here. So, I mean, did they pay too much? Maybe the market obviously thinks so, or they're going to impact the earnings short term, but long term, you got to think this makes more money for Walmart here. Gives them more of a presence in the online business, especially obviously in India, where this is a major business there. I know long term, if you're sticking this in your portfolio at $82 now, it looks a hell of a lot better than it did at 105, 106. It's funny how the street turns so much, Joel. They all love the stocks when they're going up, and they all hate them when they're going down. And I tell you, from an investing standpoint, I feel like they're doing it all backwards, because I'm starting to actually get interested in Walmart now. I have no interest in $105 when it got just silly there at the end of January. But $82, it starts to get interesting. I mean, it's in a free fall, so maybe wait for it to stop going down. But long term, this is good, isn't it?
I think so. And, what is it with some of these tech companies, or I guess it's more with the biotech companies. They're complaining about growth, and that's why they made some of the big acquisitions, for growth purposes. And this is what Walmart's doing. They're looking to the future here. You can always wait to see what the low is today, and if it settles off that low, maybe puts a triple bottom in tomorrow. Another possible trade. Let's say you open up 82.25, you flush it down to 81.40. I'm just giving hypothetical numbers here. Then come back up through that opening price, then you have a bogey, the 15-minute chart. There's several different ways to play it. Just the monthly chart's the only thing that scares me a little bit. And according to the monthlies, you're looking 77.5 on the monthly chart. That's going back to September and October, actually August to October last year. You're not going to get a shot there today, but it'll be important to hit a low today and hold that low tomorrow. Looking, are they going ex-dividend tomorrow too as well? Because that's what Stargazer's talking about. Do you have that available, Spencer? They going ex-dividend tomorrow?
Don't know. Don't have that in front of me, but
I
have no reason to doubt that.
So dividends, ex-dividend for tomorrow. And this is something I don't talk a lot about on the show. It's something I look at every single day. You can get this right from the pro, or, there's lots of places you can get this as well. But yes, it is ex-dividend tomorrow for 52 cents. So, and speaking of ex-dividend, the one stock ex-dividend today is IBM. So it's got an adjusted close. It paid $1.57 dividend. But you know what? We've talked about the strategy on the show many of times. That stocks often do run up ahead of their dividend. Walmart is not a dividend play, really. Though it's not a huge dividend play. Yep. Yeah, it's only 2.5% yield. I mean, it's these bigger ones. You get the AT&T and Verizons, which are 6%, 5% respectively. There's dividend plays out there. There's people that literally buy that thing, a few days before and sell it right after, just trying to do the dividend capture strategy. I am one of those people. I almost every quarter buy AT&T, usually a little bit before it pays ex-dividend, and then try to sell it after and sneak out with the dividend. And you know what? 4 out of 5 times, you actually usually make money on that. So those plays do work. IBM's not a bad one too, because once they start going over 4 or 5%, the dividend capture traders start jumping in. 2.5% dividend doesn't really matter as much.
And just to explain that, I know we've talked about it on the show. You can buy the stock, and because of what you're getting in the dividend, you don't necessarily, you can sell it at a lower price.
I always do.
Yeah.
I almost always sell a lower price. So if you're buying AT&T and you're just buying even of the day before the ex-dividend date, if it pays that 55-cent dividend or whatever it is, trying to sell out for 40-cent loss, and boom, I just banked 15 cents. Now, when you consider taxing situation, it's a little bit different. A professional can do that because I'm 100% taxed on everything. But you got the dividend, you got to consider your tax situation, whether it's it actually makes sense to do that if you're a retail trader. But as a prop trader, money is money. It doesn't matter how it comes in. I'm just 100% taxed on it all.
Okay. All right. Let's talk about the house and mouse.
Disney earnings,
All
Spencer.
right, let's get to the Disney earnings. Let me pull them up in my pro. Disney Q2 EPS $1.84 versus $1.68 estimate. We like that. Sales 14.55 versus $14.05 billion. We like that too. Let's break it down by segment. Here we go. Media and networks, $6.14 billion in revenue. That was higher than we thought. $4.88 billion in revenue for parks and resorts. Also higher than we thought. Studio revenue, $2.45 billion. That's higher as well. And consumer and interactive, $1.08 billion. That was just below what the consensus estimate was. So they beat the estimate on 3 of the 4 segments of the company. The earnings per share was good, and the sales were good. They didn't comment really on the Fox Comcast nonsense, besides just that they're confident they're going to acquire Fox.
You know what? It's like Groundhog Day around here. And I feel like this earnings season, the trade was, maybe it's too late to start applying this now, to sell every pop on every single stock that reports. Some of them continue to go higher, but I feel like if you look, so the play would have been like just standard. Sell the pop, maybe at 9:30 or whatever it is up in the morning, hold it for 3 days, and then cover. And I mean, or maybe even when you got to do it after hours, I guess in the case of Disney, but just selling the pops period on earnings has been the play. Some of them have continued. It hasn't worked on them all, but I feel like it's like 4 out of 5 have given it back the gains. I mean, you're going to have the TripAdvisors that did not give it back at all. TripAdvisor continues to go up here this morning on its earnings report, but so many of the big guns could not hold the gains after the earnings. And Disney House of Mouse is the same story here again. It pops to 104 last night, and within an hour, it's already trading red.
All right. Yeah, I mean, I think the only one you really would have got tarred and feather on was Apple. That one just kept going after the report. You got a spike right after the report came out to 104 even. Some people must have been happy about that because you did have a quad top at the 103 area. So I'm going to still use 103. The highs from, actually a little bit lower than that, 102.64, 102.68. That's $1.60 away. So there's your major resistance. Coming back on the downside here, you did hit near $100 in the after hours, actually 100 even. The only thing, I just like the 3-day low in this thing is way down at 98.58. So see what happens at the psychological $100 level. If you're looking for more downside, 98.58 is your 3-day low. And I don't know, with this whole Fox thing going on and the whole still ESPN and media and content, I've had this one in my portfolio.
I have it. I have it in mine. I have it in mine. I just bought it recently too. I think long term you're okay. Short term, a lot of unknowns here. So we don't know if the deal's going to happen here, if they're going to get trumped by Comcast, what's going on. The earnings okay. Still got problems with ESPN. I mean, there's all kinds of stuff going on, but there is still, Disney, I still think is one of the best brands
so much
out there.
The ESPN is one part of the company. I mean, like,
exactly.
You were just there, Dennis. You were just there. How much money do they print?
You can't move in those parks.
Yeah.
It's crazy. People paying $100. They charge my 3-year-old. A 3-year-old has to pay $105 to get in the park. And you know what? There's thousands of 3-year-olds in there. They're geniuses here. Most people let your 3-year-old go for free. Not Disney. Why would we? You're 2, you're getting free. And I should have lied, I guess, and said about his age because I didn't check his birth certificate. But, I'm an honest guy, and I paid for Spencer to go into the parks. 3-year-old, $105 going to park. Man, when they can make $105 off a 3-year-old, that's unbelievable. So I tell you, long run, I agree with you, Spencer. ESPN, they want to focus. This is what this market is. It focuses on, if you're unliked, and really Disney is right now, it's going to focus on the one negative. If you're loved, it will focus on the one positive. That's the way this market works. But I tell you still, the Warren Buffett approach, the long-term approach, is things change, and in the long run, earnings drive price. So if you can find those stocks that can still have good earnings in the long run, you will still be okay. Short run, there's all kinds of other considerations as a trader. But as an investor, Disney, I don't mind it here. I know we had Guy Adami last night at Fast Money saying, well, its multiple is higher than CBS and it shouldn't be trading with us 17 or 18 times when CBS and Viacom are trading with 12, 13 times. I'd argue with Guy Adami on that because if you're listening, Guy, sorry, but I think Disney is a hell of a lot better brand than CBS. CBS doesn't have the parks. They don't have all these other sources of revenue. I mean, you think about that when they create a movie like Avengers, how much revenue gets driven from that? So
much.
I'm
So
totally,
much.
think that Disney should trade with a premium over Viacom or CBS. So I don't think it should trade with the same multiple. I don't mind paying 17 times earnings on Disney at this price.
And I will invest in the stock when they bring back the Wonderful World of Disney on Sunday nights. You remember that, Dennis? That was on Sunday night.
Dating yourself again. I think this was before I was born. I was born in '76. When was this aired?
Let's see.
Before '76.
No, a third.
Maybe it was the late '70s, and I was like 1 or 2. I'm not going to remember this. Spencer, do you remember this? I think he's dreamt this up.
Oh, come on.
Or he's really dating himself.
Chat.
No, I don't remember.
Chat. I know.
Somebody in the chat will back you up because it's always just something that you know.
The original version aired on Wednesday, October 22nd, 1954.
Okay.
And it was broadcast for 36 years with only a 2-year hiatus in 84 and 85. And for 25 of those years, it was on Sunday. So it was great, man. You watch a little football, watch, Wonderful World of Disney on Sunday night, and then go to sleep.
Okay, we're going into an educational segment here because the chat's buzzing about the ex-dividend stuff that I was just talking about.
Are they?
Yeah, and I'll tell you, as a retail trader, it's harder to trade some of these strategies. But as a prop trader, my cost structure is so low. So it makes some of these strategies that probably aren't available. I mean, if you're paying $9.95 a trade, you can't do a lot of these strategies because it's just too much. You can't do the short-term stuff like buy the stock ex-dividend overnight and try to scalp a nickel off of it. But my cost structure is so much lower. I mean, a prop, I don't even pay commissions. So, it's profit share. So it's completely different structure when you start talking, like when you're not considering commissions, all of a sudden you take that variable out and a lot of different strategies open up to you. It's one advantage of being a prop trader, Upright Trading, shameless plug there. But, let's just talk the ex-dividend strategies and how I approach them. There is ways for retail traders to approach them. And that's what me and Joel have talked about a lot is the run-ups ahead of the ex-dividends. And don't look at stocks like, I wouldn't look at stocks typically, with under a 3% dividend. It's just not.
Yep.
So you want to look like the AT&T and Verizon are prime candidates. So let's use those as prime candidates. What you typically see, and Spencer, can you find out when the last time AT&T went ex-dividend? Can we find that information quickly? I could probably find it out too, but maybe you can find it on the background just as I'm talking here. So I'm looking too just quickly because I know you're looking at. I'm looking at an old ex-dividend date, not the next one. So April 9th is the next one, which is still. Oh no, April 9th was the last one. So yeah, it's April 9th was the last one. Sorry, we're in May. I'm losing track of dates. So April 9th, if you look that day, I can't remember if I played the AT&T, but you did have a little 2-3 day run up because AT&T was sitting around April 8th, around 35.94, and it ran up the next couple days. And then that was kind of the top. So the play really is usually if you want to play, as a retail trader, you want to trade a little bit, longer strategy. And I don't always play it this way, but the longer way is you buy it a couple days, 2-3 days before. It typically has a run up. You have to work out market effects. And, I always do spider hedging. So when I'm long something, I usually hedge it short with SPY or with something else, similar asset. T and Verizon, you could even use the TLT sometimes as a hedging tactic because they trade like bonds. But basically, just to keep it simple, typically the stock will run up a couple days ahead of the ex-dividend date, go ex-dividend date, and then be weak for a month after. We have been epically weak for a month after on AT&T. It topped out. So play is to buy it ahead, sell it ahead on the ex-dividend date or, potentially that morning when it's paying the dividend, and then short it that day too. If you shorted AT&T on the ex-dividend date, which was April the 9th this year, you were shorting somewhere between 35.06 and 35.70. A month later, it's 31.70. So it went into the gutter. Now there's a lot. That's rare. That is rare. That's just like an epic move for you. But I'll tell you, if you look back in the charts, you will find these effects, and you will find similar moves, not 4-point moves, but a dollar move. Maybe there's a dollar in there. And I used to always play these for 50 cents to $1. Now, when I'm doing the ex-dividend capture strategy, it's a completely different strategy. I'm literally, and somebody said in the chat, and I say this all the time, I'm picking up nickels in front of a bulldozer. So I'm looking, to buy the stock day before, capture the dividend, and get out for a nickel or a dime. If news comes in, I could lose 30, 40, 50 cents on that. But you know what? News can work in my favor as well. I can make an extra 30, 40, or 50 cents. It's about, maximizing, if you have a random news event, whenever you hold something overnight, you're always, subject to news. So basically, when you have news work in your favor, you got to maximize it. When you have news work against you, you have to minimize the damage. That's just trading and screen time. 19 years, when I make 40, 50 overnight trades, every single day, I'm very good at maximizing and minimizing. I'm very good at minimizing damage. I've never been great at maximizing the gains, but I'm good at minimizing the damage. Damage control, you go in, and it's always going to be a loser that you're working out of, and you do your best to do that. But, I do make my living picking up those nickels in front of those bulldozers. And, that maybe that's a difficult thing for a retail trader if you're paying $9.95 to do, but a retail trader could definitely play the run up ahead and the sell off after, because those are swing trades. And obviously retail, commissions, are negligible when you're talking, trying to make $1 on something, a point on something. Paying a $9.95 trade is not as big of a deal.
Okay. All right. Let's see here. Anything else in the chat? I can't feel my Facebook is asking about a pair trade after ex dividend, and we're just talking stock specific here. Bringing another stock.
You can pair it up though. There is that strategy usual. So if you've got AT&T, Verizon, you can't do that because they always go ex dividend on the same day. But sometimes I'll trade like Citigroup or something. I might want to do a dividend capture on a bank. So I'll buy the Citigroup and I will sell short another bank against it. Now I'm hedged. Now these again are short-term strategies, and I'm literally looking to make I will enter a trade as a prop trader. People might say I'm crazy, but I tell you, this is how I make my living for 19 years. How I make my living. I will enter a trade for a 0.1% edge. If I can find an edge that is 0.1%, so you're talking a tenth of 1%, I will put that trade on. I can afford to do the buys and the sells, again, because I'm not paying commissions, because I'm a prop trader. So I'm doing profit share. It's a different arrangement. But, so I can enter trades. I can make, if I make a penny on something, I'm making money. As a trader that's trading, with retail commissions, you can't do it as easy because, you're not making money on a penny. You're going to end up losing because there's cost structures involved in that. But, just going back to the original point there, I do that dividend capture all the time. I did it overnight with IBM. I'm long IBM here right now. So right now, IBM, I'm long it still. I've been trying to wiggle out here in the pre-market, but it's not that easy. I'm long IBM, short SPY against it. So right now, SPY's up 0.737%. IBM's up 0.42%. I'm up 0.05% on that trade because I put them on to close. So I'm trying to work out of the IBM for a little bit better price than on my short SPY. So you can see, I'm entering that trade. I'm hoping to get more than 0.1%. Right now, I'm only up 0.05%, but I'm not. I'm just telling you, I can enter these trades for a very small amount. So it's just a different, strategies. But it's difficult to do the actual dividend capture in investment account or in a brokerage account because you have those commissions. But I would say if you're listening and you're at a retail broker, talk about those run-ups ahead. There's big run-ups, or this AT&T selling off 4 points afterwards. A lot of times AT&T will sell off $1 after the ex-dividend date in the next couple of weeks. There's a total play there for you guys. So, don't be scared. And if you don't have a margin account, you should be shorting stocks too. People who are just long only are missing out on a lot of potential profits. I play market neutral all the time. I'm almost always hedged. So what does that mean? I'm taking out the market risk and I'm trying to extract the alpha of, that run up ahead of the report. If the market tanks, that throws other, variables in there. So all I'm trying to do is extract the alpha of the inefficiency of the dividend. So because it's not as efficient as it should be. And there's a number of reasons for that. And taxing structures are behind it as well. But, there is that tendency for a stock to be strong ahead of the ex-dividend date and week after. And that's what I'm trying to capture.
Okay. Just real quick here. Boom, boom, boom. You don't necessarily use the leader, sector leader. This is more do a scan, find the stocks that are paying over 3%. So it doesn't have to be necessary.
Even 4. Go over 4.
Go over 4.
Three's light. Go over 4 because you want 1%. So if you're paying a dividend quarterly, at least on a 4% dividend, it means it's paying you 1% for the event. So you're trying to capture 1%, and then you're maybe only trying to lose 0.7, 0.8%. So you're trying to capture 0.2. That's the pure dividend capture strategy. If you have a very low commission structure, which some of you guys do, some of these retail brokers are great now. You might be able to do some of these strategies in a retail brokerage account. If you're paying over $10 a trade, probably not. But there's a lot of cheap brokers out there, and there's some free commissions out there too. I think about some of these others as well. So there's ways to get that down. But if you're trading actively and you have a cheap structure, these are strategies you can employ.
When Oldie had commission-free trading, and this was back a long time ago for over $100,000 accounts, these guys would come in with 10, 20, 30,000 shares of Aetna and some of the other big dividend players, and they would just try and buy it on the cheap. And sometimes if you're long, depending on the market environment and what your holding period is, market structure, sometimes these guys would come out, they would get the dividend and end up profiting on the stock. But that's
a dream scenario.
That's a dream scenario.
You get a 1% dividend and you make money on the stock. That's what you'd love to do. I mean, right. I'd love to do that all day, but I'm just saying if I make 0.1%, I'm still happy. If I can make 1%, those are dream scenarios. And, that's just going back to our strategies too. I'm doing a lot of different types of statistical arbitrage. All that is a stat arb strategy. It's a different type, but there's a statistic there that shows, the stock's strong ahead and week after. So you are trying to extract the alpha of that inefficiency in that statistic. That's all stat arb really is. And there's lots of, everybody says stat arb, they think you're automatically pairs trading. All kinds of other statistical arbitrage strategies too.
Okay. All right. Let's, Walmart wasn't the only one with big news. We have some earnings, some big beats. You want to talk, go TripAdvisor?
Do it.
Okay, Spencer, give us the numbers.
Oh man,
Spencer fell asleep.
That was yesterday. I didn't realize they were out. I thought they were this morning for a second, but no, they were yesterday. I actually forgot. Q1 EPS 30 cents, very nice versus 16-cent estimate, so they almost doubled the estimate there. Sales 378 million versus 362 million, so very nice on the sales number as well for Trip.
Stock trading up substantially in the pre-market, and this one did not work. If you were shorting this, after on the pop, it went 42, 43, 44, 45. It kept on climbing. I mean, you're talking about stock getting back all of its losses for the last 2 months. Now you start to think, am I buying it up here 46 though? I mean, it's not leaking. That's the good news. It looks like it wants to be up here. We've had a full, 3.5 hours of price discovery last night, another 4 hours here today, 4.5 hours here today since we opened at 4 a.m. So it wants to be up here. It's trading up here on volume. Now, I don't know if I'm coming here chasing anything because we have not been rewarded for chasing pops. This thing up 18% on one report, not for me, not chasing it.
Very, very interesting setup. I'll make it very clear and easy for everyone listening. Your pre-market high is 46.80. You had a spike high, I think, after earnings at 47.02. Excuse me. So you need clear that pre-market high, get into the 47 handle, or you're going to give back some of these gains like you did. They probably reported on February 14th because they went to 40. They had a 40.72 close, hit 47.02, but ended the session at 42.40. So very important for the stock to hold the early gains and get into the 47 handle.
What about Booking? Did they report yet? BKNG. I think they're due to report any minute, though. They were on my schedule for this morning. They're on your schedule too,
Spencer? They're on my schedule, but I didn't see it yet.
They're usually 8:30, so I bet you in the next minute we're going to get Booking. So keep an eye on BKNG. You can see some wild trading action. That's the old price line. I still want to call it price line.
I know.
And I still want to type in. Joel will be typing PCLN in for the next 20 years. So when we talk,
you know what?
Why did they change their name? Why did they do that?
Because there's more. There's so much more to the business than just Priceline.com.
Dennis, I wish I could show you my screen right now because I have
PCLN.
I have PCLN on my screen. It says data request failed, incorrect symbol.
Oh, I know. I do it too, and it locks up my whole system. Usually when I'm typing the wrong ticker. So this doesn't exist. What are you doing? It says. We're waiting. Let's go to imbalance here.
RCA says bookings tonight, Dennis.
Oh, is it tonight? Yep. Okay.
Oh, you know what?
Here. I thought it was.
I didn't look closely enough on my calendar. Hold on, let me see. Yeah, that's a good possibility.
Tonight?
Yeah, good call. We would have been waiting for a long time. So good call on that one.
It's 8:30 in the morning.
They are after the bell. There we go.
Looking after the bell, so we're waiting on that one. There's 130 stocks to report today, and obviously we've got some big ones there tonight. We're going to hear from Fox, which will be interesting too. Let's go to a few of these smaller ones. It's a company that I'm kind of kicking myself on here. GoDaddy, GDDY, it reported earnings, Spencer. And why I'm kicking myself is I had this on my list to buy. I wanted this one. This kind of had a good growth, and it was back there at the beginning of the year. And, I wanted to buy it around $50, and now 65, and now 68 in the pre-market. So kicking myself that I did not put this one in the investment portfolio. But anyways, Give me GoDaddy numbers. GDDY.
The Q1 EPS 2 cents, in line sales 633 million versus 622 million. Q2 sales guidance higher than the estimate, 635 million was the estimate. 640 to 645 is what they see for the quarter. The fiscal year sales guidance was higher as well by about $500 million. I'm sorry, $0.05 billion.
So stock gets a lift, new all-time highs. Joel, what do you say about this? This is the thing. You know what? This business, it's the margin's got to be nice, eh? Like, I mean, I pay them, for my URL, and I've got a couple of them there. We got the PreMarketPrep.com, and we've got a couple other ones, but they just collect. It's like $15 a year. But I mean, what's their cost for that? It's like nothing. You do the web hosting and stuff with them too. That's where they really make some coin on you. I mean, what's their expenses really once they're up and running? I mean, it's just gravy every time you get another, obviously marketing is probably a huge expense because they got to keep marketing themselves. They do have some pretty badass commercials, but man, it's a nice margin business.
Danica Patrick too. Boy, the only thing I can say is, I know we look at different time frame charts. I try not to go any shorter than a 15-minute, but if you were just going off the monthlies in this one, it's had one losing month since January of 2017, and that was in September, when it went from 44.82 to 43.50. So if you're using your monthlies, just kind of like the opposite with GE. How's GE doing? It had that green candle last month. Look at this, Dennis. Should we call it bottom here in GE? 12.
Kramer did last night.
He did.
I'm long it overnight because of Kramer. I bought it last night when he started pumping it. Yeah, you know what? You got to watch that Mad Money because I'm like, Jim Kramer came in pumping it. People pay attention to him. It could get some love here today just because of that. He said, he was saying that it might be safe to jump in G. So he beat us on this one there, Joel. I know sometimes we beat Kramer on some calls, but he's saying it ahead of us here. So we're stealing a little bit of Jim Kramer's content here from last night because he said that he thinks, it might be safe to jump into GE. 1440 is trading up there. It's 249,000 shares to buy too. So somebody big institution in the pre-market thinks so as well. Like I said, I am long it just short term here. It'll probably get out today, but I think there's room to 15 here.
Okay. All right.
Spencer, that's good news for you. Where'd you buy, Spencer?
I'm like in the 1560 somewhere, 1570.
Take it back to Spencer's break even, then we're sell.
Then we sell. Okay. 8:33. A minute or so before we're going to go to our guest. Was there other imbalances you wanted to hit on?
Let's go take a look. So GE jumped out at me. Alibaba 35,000 to sell. That small man, that Baba's a monster. There it is again yesterday, trading down in the pre-market. It can't close red though. It just finds buyers. It opened and just literally runs up again yesterday. You know what? They're all small here today, and okay. I don't even think I'm going to waste your time. I don't see anything really jumping out at me.
All right.
You want to do Monster real quick before we go to the break, or you want to cover it after the break?
Monster beverage.
Yes, sir.
MNST.
Let's do it after. All right, 8:34. We're gonna take a quick break and grab Gil Morales. He is managing director of MoKa Investors, the author of the Gilmo Report. So we'll be right back in a moment with Mr. Morales. All right, welcome back, everyone, to PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Stick on now with Gil Morales. He is the author of the Gilmo Report, managing director as well of MoKa Investors. Gil, you're out in LA. How are things out in sunny California?
Oh, it's beautiful. Weather's great. Nice springtime weather, and we're enjoying it.
Did you guys feel that earthquake?
But we had one, I think, about a week ago. It wasn't that big. So,
Okay.
I mean, unless you're getting over 6.0, like they had a 6.9 in Hawaii near Hilo the other day, that's a pretty good size. But I think it was about a 3 to 4. So that wasn't really anything too earth shaking.
Only a 4. God, if a 4 happened in Detroit, we'd all run for the hills. Only a 4.
Exactly.
Okay, though, not a big deal. Only a 4.
All right, Gil, you're getting some compliments here in the chat. Terry Kern said he's read a couple of your books. Really good stuff. Why don't you just real quick tell us about some of the books that you've written, and tell us about the title of the next one coming out.
Well, I've written, let me see here, I think 4 altogether. The first one I actually co-authored with Bill O'Neill himself, which was How to Make Money Selling Stocks Short. That was published in 2004. Then with my business partner, Dr. Chris Katcher, we published Trade Like an O'Neill Disciple, which came out in 2010. And in the Trading Cockpit with the O'Neill Disciples, which was a follow-up to the first book, sort of a workbook of sorts, that came out, I believe, in 2012. And then in 2015, 2015, yeah, I basically wrote Short Selling with the O'Neill Disciples, which covers more details or covers the short selling aspects of the market in much more detail. The next book, I'm still trying to figure this one out. I mean, I've thrown around some ideas like, trade like an algo, because this market seems to be entirely algo driven. And I think you have to develop trading strategies to adapt to the fact that most of the volume is machines, and you're trading against machines most of the time. So you have to think like one, I think.
And how do you train yourself to think like one? Are you trying to?
It's basically a matter of, as Bill O'Neill used to say, the term speculation comes from speculare, which means to spy and observe in Latin. And that's what you're doing. You're observing what the market's doing, and you're trying to discern patterns in what you're seeing. And I think, people like to say, well, the market's crazy, the market's this, the market's that. Nah, the market is the market. And it's your job to figure out what the market is telling you. We're not in the prediction business. We're in the interpretation business. So we're not here to predict where things are going to go. We're just trying to interpret what's happening and how we can make money. Now, the thing that I notice about this market is that we're generally range bound since late January. We had that nice move in January, and then we rolled over, and we've just been chopping back and forth. You're starting to tighten up a little bit. But that volatility creates these movements that are very typical, where stocks begin to look very ugly, and they will generally undercut a major low in their pattern, and then they'll turn around. And for me, the trigger point, and this is actually a Wyckofffian spring from Richard D. Wyckoff, who was a trader in the early 1900s, who first wrote about Jesse Livermore. When it undercuts that big prior low and comes back up through it, I'll use that as a trigger to get long and use that as my stop. A very good example, case in point, shall we say, is Apple. And if you look at Apple a week and a half ago, it was undercutting a major low in its pattern at 164.47 and was looking pretty grim at the time, because there was a lot of talk about how they're going to miss their numbers and blah, blah, blah. And as you turn back above that low, that would have been 1, 2, 3, 4, 5, 6, 7 days ago. Okay.
Wow.
As you turn back above that low, you can buy the stock there, use that as your stop. So you're keeping risk to a minimum, because there's no guarantee it's going to work. And then you get a sharp move, and that move takes you all the way out to a breakout. And now you're in all-time highs, and you've broken out. Now, what I notice is once something breaks out, it has very little upside thrust from there. The best thrust actually comes from the move off the lows. And I'll give you another example. I don't know if you obviously can't show charts.
Yeah,
we do.
We
Yeah,
can
we're
show
showing
charts.
Okay, well, you can look at AMAT, and if you look at Applied Materials back in early February, that undercut the 48.26 low of early December. And it did that in early February, which would have been around February 9th. It undercut that low, and then it turned back above it. And if you look at that pattern, from there, that thing just shoots back up to the highs. It breaks out, gets about 2 points of breakout there, and then the whole thing rolls over again. So the sharpest moves come on these big undercut and rally moves off the lows. A lot of times when the stock is breaking its 50-day moving average or 200-day moving average, and of course, that's when all the technicians say, oh, that's the end of the world. But in this market, the algos know that. Okay. And I think that they use that against people, and they just take all your stock and they just turn it right around, and we head back up the other way. So that's what I call the undercut and rally, or UNR long setup, is probably my primary weapon in this market. And you can make money using that. And it works pretty well, because you get very sharp moves off the lows, And then once the thing breaks out, it goes nowhere. And, that fakes out all the O'Neill style. It's the traditional O'Neill style buyers, because they're all waiting around for a breakout. And, what's happening instead is this big undercut and rally, and you get this huge move off the lows. And, you can look at the chart of AMAT back in February. You look at the chart of Apple just recently, and you can see that you're getting these very profitable moves. All you need is a method for playing them, and most importantly, a method for keeping your risk to a bare minimum. And you can do that with the undercut and rally setup. There's a few others that I use that I'm on that I talk about. And, the Chinese names the other day, over the weekend, same thing. You look at Sina. I think Sina might be coming off this morning because Weibo announced earnings and they were down last I checked. But if you look at Sina coming up.
Sina reported too.
Are they down? Let me check.
They reported and they're trading down. Yeah, Sina. I think Sina was due to report too.
But ahead of earnings, okay. If you look at Sina, you can look at its pattern, and you can see back in early December, there's a 94.06 low, and it came up through that low. I think on Friday, and it closed at 94.13 on Friday. You could have bought that there, and boom, you get a 6-point move over the next couple of days ahead of earnings. You bail out ahead of earnings. I don't hold anything through earnings. I call it playing earnings roulette, because that's basically what you're doing. It's like spin the wheel and see if it comes up red 19 or whatever the red numbers are, and that's what you're doing, right? I mean, sometimes they go up and then sometimes they blow up, and I don't want to be sitting in anything that blows up, especially if I have no profit cushion. I mean, my general rule is unless I have a 10% or better profit cushion in a position, I'm not going to hold it through earnings, not in this environment.
Gil, this is great stuff. And Dennis Dick, I've been a prop trader for 18 years. And I can tell you the one thing I noticed, that you're just talking about is the adjustment in your trading strategies that you seem to probably constantly do. I mean, here you were, and you're talking about classic breakouts and fading those classic breakouts as trades right now. And you're basically talking about your classic crowded trade. When the setup is, I always say, when the setup is so pretty, it's so textbook, it almost always doesn't work because everybody else is in it. So it's almost always a fade of those strategies.
Right. And the algos know it. They know it. And that's how they trade. And you see them do it, So I think that's what you got to adjust. A lot of people will criticize me for, well, you're not Ken Slim, you're not following Bill. Well, you know what? Yes, I am. Because a lot of this stuff, Bill O'Neill used to talk about undercut and rally type moves, and he used to show me patterns because we had to advise institutional investors at one time. I was the head of the institutional group at O'Neill, and we had over almost 700 clients at the time. But if you think about it, who buys stocks off the lows of consolidations, off the lows of bases? Do you think they just magically rise? No, institutions are in there buying them. They're the ones who create the bottoms of bases. So we identified that there are certain patterns that they can use. And when we're talking to these people, you can't tell them, oh, yeah, buy a breakout, because that's where, all you guys are buying, because that's what O'Neill says in his book. When the institutions start buying a stock, it's like an elephant getting into the bathtub when it breaks out. Well, not anymore, but those elephants were already quietly getting into the bathtub at the bottom of the consolidation. And so O'Neill would talk about, undercutting major lows, 3 waves down, stuff like that. And a lot of this stuff is derived from Wyckoff and Livermore. I mean, if you go back and look at Livermore's shakeout +3 rule, that was actually a bottoming rule that he would use. And he also had his pivotal points were turnarounds off of lows. And he had ways of figuring these out based on how he was reading the tape. So none of this stuff is new, but I think it's new to this type of environment because you're not really in the same post-World War II secular bull market that you were, say, in the 80s and 90s. It's not buy a breakout and sit there and the thing goes up forever. There are some names that will do that, but the majority of these breakouts are failing. And I think a lot of people who are using strict Ken Slim style breakout buying are getting knocked around pretty good.
I mean, in a sideways market, this is when you really see it. And that's what we've had for the last 3 months is really, we've been in a trading range. And, every time a stock pops, it seems like 5 or 10%. You look at it a little bit later and it gives it back. So, I mean, it's all about certain strategies in certain environments, when you say, Gil?
Right. Exactly. And I think this is a swing trader's environment. Does it change? I don't know. Right now I'm seeing these indexes. If you look at the pattern since late January, they've been swinging around and swinging around. Now the last few weeks are starting to tighten up. You got the NASDAQ above its 50-day, the Russell 2000 above its 50-day, the Dow and the S&P are pushing up towards their 50-day. So I think we're at a critical juncture here. If we don't see the S&P primarily the Dow's kind of too narrow, but it does figure in these days because people buy big stocks like Dow stocks a lot. And I think if we see those regain their 50-day moving averages, then we may make a move back up to the highs, which I think would be very tradable. If we see the opposite happen where the NASDAQ and the Russell fail and roll back through their 50-day moving averages, then we've got a problem again. I mean, it's only a problem for people who sit there long, and those would probably be the people who listen to guys on TV who tell you, every pullback or every sell-off is a buying opportunity. But what I want to know is what money do you use to buy that buyback or buy that pullback or that big drop when you never sell anything? What are you doing? Breaking your piggy banks, I guess. But
Gil, I want to talk to you a little bit about the volatility coming in, and that was one thing. We got the 9-day average ranges, got up in the 60, 70 area, and one thing I was looking for, was for the ranges to come in a little bit and calm down, and I think that bodes well for the market here. Get back to that old style of just grinding out these gains. So the volatility coming down, I think, is overall good for the market. Any comments on that?
Well, yeah, I think that kind of dovetails with the point I was making about the index is tightening up. So by definition, if they're tightening up and you're seeing less of a swing, you can just look at that. It's pretty visually obvious on the charts of the NASDAQ, say, and the S&P. They are starting to tighten up over the last few weeks. The VIX is still trading around 14-15, which is elevated from where it was earlier in the year when it was trading around 9-10 near its lows. But I think maybe that's a healthier level of volatility. It tells you there's a little less complacency in the market, which may be constructive. I mean, I got to tell you, Joel, the patterns that I'm seeing, you look at, say, Netflix, you look at Amazon, and those are also typical breakouts that fail. And then what you want to be doing is buying the pullbacks when it looks like your breakout is failing. But those are all setting up pretty tightly. Intel seems to be setting up. So the very subtle clues I'm picking up from some of the stocks is that we may be setting up to go higher here. So I am looking primarily for a confirmation from the S&P coming up to the 50-day moving average. Now, if I don't get that, I'm ready to flip short. And I will be testing the short side every day in small size. I use two vehicles, the SQQQs, because I've felt that the NASDAQ big stock techs are the crowded trade. So if we come off, they tend to come off the most. And I use the UVXY, which is the leveraged VIX. And I have a method using what I call a 620 intraday chart that I use as a tool. I mean, there's probably a lot of other tools you could devise in terms of a intraday chart that has you're using moving averages and MACD to determine trigger points. But I will use that as a hedge if I think the market's going to pull in. And that's been one way to remedy the volatility when you're trying to hold at least some positions in a market where you can swing 200, 300, 400, 500 Dow points, in a matter of an hour. I mean, it's getting to the point there where if you went to the bathroom, you come back and the market's 200 points in the other direction.
Can we throw some symbols at you kind of here on the fly and just get a quick analysis before we let you go? We got some people in the Google chat. The first one is Match Group, and they did report. Looks like a halfway decent report here. This just got walloped on the Facebook going into the dating game. Here you had that one. You had the big down day. Then you put in the double, triple bottom. Give us quick analysis of MTCH.
On the MTCH, I'm looking at that. The great earnings. They just came out with 117% earnings growth on 36% sales. Is Facebook going to take them out? I don't think so necessarily. They're going to be competition, but yeah, there's a lot of competition in this space. So what I would do here is this looks like a bear flag, and it looks like it wants to test the 200-day line. If it tested the 200-day line, then that probably means that it's going to undercut the 32.40 low from early February. I would use that as an undercut and rally trigger. In other words, if it hits the 200-day line, bounces off, and comes up to that price point, I'd go long. Now, let's say it doesn't break down from here. Your next highest low would be 38.48 from March 2nd. Okay, you're trading today, what was it closing? 36.32. So you're only a couple of bucks below that. If it came up through that low, I might be looking at going long there, using that as a stop, because I think this may just be a temporary thing. And you've had 5 days for investors to kind of figure out what's going on. You've had some good buying volume over the last 4 days. So it has a reasonable shot at coming back, if unless you think that Facebook, which is now the evil empire, I suppose, along with Amazon, they've joined forces to take over the universe. but I think this has some potential to come back, so it may be good for a trade.
All right, I give you a tougher looking chart for you here. NVIDIA just knocking on the doors of all-time highs here.
Now I want to point something out here on this one. If you look at this chart on this has been I think 2 weeks ago, the stock undercut the 213.07 low of April 6th. Okay, so that was 2 weeks ago. It undercut a low that's about a month ago. So it hit 210.30, came close to the 200-day line, turned around, rallied back up through 213.07, and it hasn't looked back since. So that was a buy at that point. Okay. So it was a buy at 213.07. We're now up pushing 250. You got earnings coming out tomorrow. I would have taken the trade that way. I wouldn't be buying it up here ahead of earnings because again, you're playing earnings roulette. But the pattern looks good.
All right, let's go from a high price stock to a low price stock. Blue Apron here.
What is that, Blue?
It's a APRN. This got a nice boost, didn't Kevin O'Neill? Wasn't this on the stock draft? Wasn't this his pick, Spencer? Wasn't this?
But Kevin O'Leary, picked Blue Apron.
Okay. Well, I mean, let's look at this objectively. If you look at the pattern 4 days ago on May 3rd, the stock actually had a bottom fishing pocket pivot coming up through its 50-day moving average. So that would have been the buy point right there at a price of $2.30 whopping cents. Boy, that's a penny stock. And now you're up from there. You're up at 284, so not huge. I mean, I guess this could be considered in buying range, but I would be wary of anything that has a move because of news like that when somebody's pitching it. But objectively, if you were on it 4 days ago, that would have been a buy point. You could control your risk by using the 50-day moving average as your selling guide or your stop, and you would be up from there. Now, up here, you're buying it up further, so there's more risk because you would use a 50-day line as your stop.
Gil Morales has been on with us for the past almost 20 minutes now. Felt like 2. Gil, thanks so much for the time. We appreciate it. We'll have to have you back soon.
Okay, great. Sounds good.
All right.
My pleasure.
Thanks, Gil.
Take care.
Great stuff there.
That was one of the best interviews we've had. I mean, he's just talking about a lot of stuff. It's funny, like he's talking, technically on a lot of stuff that we kind of go roundabout's way of talking about too. He's got different strategies he's named and acronyms for it. But, I always talk the breakdown, become a fake down, and then start to go back up. And he's talking once it does go back up, there's a full strategy to buy that, playing it up right there. Even Walmart, we were talking about there today and just saying, and I'm one that actually tries to get the bottom and, he wouldn't be buying Walmart until it got back up over 85. And maybe that is the case and maybe it doesn't, but there's no trade here until it gets back over 85. And it's a lot safer way to play it as opposed to saying, I think it's going to come back and trying to call the bottom. He's playing a statistical edge there. So great stuff from Gil. Where do you want to go here now?
Oh, I just want to say one other thing here, that these strategies that he talked about, and we talk about them in reference like to the opening trades, but when he's entering the trade, he has an exit. That's the best thing about whether short-term investing or long-term investing is taking that trade, hopefully getting out at a profit, but preparing for the downside scenario. And that's one thing that was really good. So we got
Joel, you've applied that strategy that he's talking about to the opens. And you were talking about having that opening price. And when a stock opens at a certain price, say stock XYZ opens up 50 cents at $50 and runs up a little bit. When it comes back down through that opening price, that's when you execute your short. So it's the same strategy that he's talking about. Obviously, we're talking on the short side. And instead of using, the technical reference there, you're using the reference of the opening price. Why? Because there's a lot of people marked from that price. It's a big event. It's a big liquidity event where there's a lot of people long or short from that price. So that's a price where people will be looking to reverse their position or possibly cutting losses. So, something you taught me way back in 1999 is actually very similar to what he's talking about, when the stock breaks down and then comes back up through the price, that's a buying opportunity. Same thing applies on a day trading basis on the opens when you're talking about the opening price. So look where the stock opens, the official open, if it's an NYSE listed stock, what's the official open on the NYSE? If it's a NASDAQ listed stock, what's the official open on the NSDQ. You can tell that by just looking at the time and quotes and looking at the big print. Where did the big print go off? And if you have a stock that runs off that and then comes back through it, a lot of times when it come back through it, there's a sign to either, get out of your original position or possibly reverse it.
All right, Four Spinner in the chat. He wants us to take a look at Facebook here. And boy, this is a real interesting chart. You had all the news, and Zuckerberg did a good job and good earnings report. Now you got a rally, but you're really almost identical ranges yesterday. So for the long side, as long as we hold the double bottom from Monday and Tuesday at 77.17 and 77.11, that's a lot of sevens there. I like it. On the upside here, not quite a double top, but there's a seller in the 179 handle. 179.04 was yesterday's high, and 179.50 is your 2-day high. And then also when you got a gap to fill from when that bad news started, and that's up to 183.41. So, it could just be resting here, but boy, I sure like to see this clear 180, go fill that gap.
Big.
Yeah, 180 is big. Not worried about any downside until we take out 177. Dennis, any thoughts on Facebook?
No, just the same thing. 180 is your key number here. It's not surprising it's starting to stall there. We've got a couple lows just below. We're here again. I always say third time's a charm. If they can get up there and take out 180, then you are in a little bit of breakout mode. But again, remember, a breakout has to remain a breakout. So, if it starts trading 180, 181, and then starts coming down to 179.5, that's not a breakout anymore. So you want to see it continue to break out. You got to be very cautious that those breakouts don't become fake outs. And a lot of breakouts in this environment have been fake outs, as Gil just said.
Oh boy, here's a Sean Udall stock that we should have probably talked about before. Twilio on the way back here. Nice report. You want to give us that report, Spencer?
Sure. TWLO reporting yesterday after the bell. 4-cent loss EPS that beat the estimate by 3 cents. Sales 129 versus $115 million. Q2 sales guidance coming in higher. 123 million was the estimate. 129 to 131 is what they see their sales for the current quarter. That is EPS guidance for Q2 coming in more or less in line. The fiscal year numbers were higher as well for both the EPS and sales.
It's a huge pop breakout here for Twilio as well. Over 45 was a key number. It's funny. Some of these love stocks that eventually, get hated for a while seem to eventually come back, the really loved ones. And this one, had the IPO where it took off, got above $70, and, really, after that, really went into the gutter for a long time. But, for 2 years, really. But eventually it started to break out and get some love again. And now it's got the full love going. So you can see how sentiment just turns. And then, this trend starts to become your friend here again. And that's what Twilio is. So as the stock pulls back, it seems to find buyers.
Boy, the initial spike took it up to 48.93. And then you had a real nice dip. So this thing is volatile. You had a dip down to 45.35. Now it's just a slow, steady climb back. I would use two objectives on the upside. One is that pre-market high at 48.93, and then I'll just give you $50. And not that it's I can't tell you if there's any highs in there from the daily charts. I would just tell you that it had one bad month, and this was back in October of 2016 when it went from 64.36 to 34.12. So everyone that's been buying since that time, they might have $50 as a target. So it's coming back on the downside. It's just a steady trend up right now. I would not worry about giving a lot back until you took out that dip at 45.35.
All right, let's do Monster real fast before we go, because we said we'd do that and we didn't. Monster,
and we got Rob McLister coming here too. So
all right,
let's do MNST.
All right, we'll do it quick.
So don't leave us here, guys. We're actually going extended pre-market prep here today. We're getting
with
our
Dennis.
mortgage.
With Dennis.
Yeah, I'm going to stick on because our buddy Rob McLister's coming on. The mortgage, the specialist there from Canada.
All right, here we go. Real quick about Monster beverage Q1 EPS 38 cents. That missed by 2 cents. Sales 850 million versus 849 million. So pretty much in line. Slight beat there. They beat by $1 million.
The beat, it's getting the beat too. It's down $4 here. Trend is not your friend in this one, as this thing You might get a relief pop here and there. There is a lot of support here. So if you look back into April, May, June, July of 2017, you had lots of lows in the 49 handle. So I don't know if it's going to be the whoosh down, but I don't like picking bottoms in stocks that are in downtrends either.
I'll go with that. You want to call Rob on the fly here, or you want to take a quick
no, let's take a quick. Let's not do him like that. It's his first time on the show. So we'll take a quick break and we'll grab Rob McLister, and he's with RateSpy.com. We'll be right back. Welcome back, everyone, to Pre-Market Prep. Spencer Israel, Joel Elconin, Dennis Dick. The usual crew with you here now with the new guest, Rob McLister. He is the founder of RateSpy.com. An old friend, I think, of Joel and Dennis's. So I'm going to let you guys run with it. And I'll be here in the background.
All right, I'm not gonna embarrass him too much here, but this man traded with us back in the Bright Trading office back in the late '90s, and Rob, you were a man far ahead of your time. I mean, you were a high frequency trader before there was high frequency trading, working with your own algorithms, your own trading systems. How do you feel about being ahead of your time?
Well, I was ahead of my time, especially with flat panel TVs. Remember that desk I had? I got about 12 flat panel monitors on there. Back when they were $3,000 a piece. I'm pretty proud of that.
I got a whole bunch from there. And what went on in that little? So if we just take you back to the Bright Trading office in Detroit, see, Rob was secretive. He had his own little room where nobody else could go in there. And he was out running some, obviously some algorithms, running a lot of stuff. What was going on in that room there, Rob?
Well,
the secret room, the secret trading room. Can you give any secrets now?
Yeah, I had to keep the door closed in that room at all times because, you know, we had some bratwurst sausages cooking in there, and I didn't want the whole office eating my lunch. But no, we had a cool little filter trading operation going, and we had some formulas and stuff, and they were working great back in the day. And then, believe it or not, computers came in the market and changed everything.
So you left. What year did you leave trading out of the Braid office? What year would that be? 2001, 2002?
I'm not sure. My last year trading was 2007.
Okay, so you traded for a while after that, and just talk about what trading was like, and then what made you change, and obviously change careers, and then we're going to jump over into what you're doing now.
Yeah, well, when I started back in 1998, making money was as simple as looking for like a 5,000 bid with 500 shares on the offer. We had eighths back then. It was a whole different world, right? And then so we created these filters, basically just little simple programs that popped up and told us when stocks were about to make new highs and had a big bid coming in, and vice versa for shorts. And it was really that simple. Like I feel blessed to have made money as long as I did using such a silly strategy.
Yeah, it was just like big buyer buy, big seller sell, just reading the tape. And, that's what worked out very well back then. And obviously everything has changed because, institutional money got smarter. They weren't just throwing up big bids and big offers. They broke it up, and, they're using their own algorithms now. And they try to hide their trading intentions as much as they can. But they really were just playing with open hands back then. So trading was just a lot different than it is now. So tell us about what you've moved into now here, because you dominated the trading market for a decade, and now you're dominating the mortgage market, Rob. Talk about your new business.
Well, my wife and I went to get a mortgage back in, what was it, 2005 or so, and we thought there was a better way. We dealt with lots of human beings. We thought we could take some human beings out of the process, save consumers money, automate a lot of it, and that's what we've been working on for ever since.
So ratespy.com. Now, if we're using RateSpy, how does this work?
So ratespot.com is a mortgage rate comparison website. So what we do is we scan the entire market, every single prime lender that publicly advertises rates. We scan them 4 times a day, put the data up there so consumers can do a little price shopping.
So you've used that trading algorithm strategy to now go into the mortgage, obviously, and get algorithms rating there for you too to try to find the best mortgages. Talk about what mortgage rates overall have done in Canada, because obviously we've had very low rates in Canada for a long time. It's led to probably a big housing bubble in some of the bigger cities like Vancouver and Toronto. Talk about rates and where you think rates are going, and what that means for housing and the Canadian economy.
So up here in Canada, the 5-year fixed mortgage is the term of choice for the majority of folks. And that is up over about a point since back in, the Trump election days. And, today we just made a new high, almost a 7-year high on the 5-year government bond yield in Canada. And fixed mortgage rates are driven by bond yields. So this is going to be a very interesting next few weeks.
What does that mean for housing prices? Have housing prices come down in Canada, or are they still on the upswing? Because it's just some statistics there. There's Toronto prices have went up something like I was reading like over 300% in the last 15 years, which seems a little bit unsustainable. And I may be wrong with that statistics. I just read it from Twitter. But do you see housing prices continuing to rise here, or do you think this, interest rates is eventually going to bring down prices as well?
Well, the higher yields and mortgage rates go, the more unaffordable housing gets, other things equal. So, you see a point hike in rates and buying power goes down 8 to 9%. So, in a market like Canada that was so overheated, every negative factor is material. So, we've already seen prices down 10% nationally. Year over year, we got the new government stress test, which is it makes it harder to qualify for a mortgage. We got foreign buyers taxes in our biggest city. We got just bad psychology overall. So you add rising interest rates to the mix, and other things equal, it's bearish for home prices overall.
Let's talk about oil a little bit here. And there's been a really nice rally in the oil market. The relationship between the Canadian dollar And the oil market is really broken down here. The Canadian dollar has come off the 80-cent level here. What are you attributing that to? Just no rise in interest rates or in Canada? And do you think that this relationship will come back into line?
Yeah, so traders are keying off the gap between expected U.S. and Canadian interest rates. So, there's a good chance that Canada won't be able to match the Federal Reserve hike for hike, and traders know it. So, we've got a potentially growing divide here between GDP in the two countries. We have, on the Canadian side, we have consumer risk if rates go up too high too fast, because people have gorged themselves on debt for the last or through this millennium. So it's a different market than down in the U.S. And the Trump stimulus is going to rise the tide for all boats. But I think that the U.S. is economically certainly more of a superpower than Canada at this point.
And
so what I was going to say, what do you think about the Canadian dollar going forward? If we cannot match, if the Canadian, and I'm Canadian too, that's why I say if we, but if, Canada cannot match the US, in interest rate hikes here, does that bode, do you think the Canadian dollar, which is trading at 130 on the US dollar right now, do you think it continues to weaken here? Or, can oil prices, if oil prices are climbing, save the Canadian dollar if we can't match interest rates? Or do you have no projection at all? What's your projection on the Canadian dollar?
Yeah, my prediction is I don't like to make predictions, but the fact is that oil, if it really went higher than expectations, we're at $75 to $80 in WTI. WTI oil seems quite achievable, but if we far exceed that, by all means, that's the oil industry is where Canada not so long ago got the majority of its business investment. And so, the oil market could save the day, but and if that happens and we get more business investment and GDP starts to heat up again in Canada, then certainly that rate gap could close between the U.S. and Canada, and the other things equal, that could be beneficial for the loonie.
Okay, and JV Spec in the chat is asking, are the Chinese still buying homes in Canada like before, or has the foreign tax slowed growth down?
Yeah, so they're, the markets without the foreign buyers tax are seeing above average activity. So take Whistler, Montreal, those types of places where they haven't been, where the government hasn't taken the opportunity for a tax grab. They're seeing above average foreign buyer activity.
Okay, and Rob, we got to get you over to the Benzinga World Headquarters before you make the move to Florida. So we got to get you over there real soon. So Rob, great talking to you. Rob McLister of RatesBuy.com. He is the foremost authority on Canadian mortgage rates, former trader, good buddy of ours. Rob, we'll be talking to you soon.
Take care, guys.
All right.
Thanks, Rob.
Okay. All right. Dennis, I know you're way behind there for the Open, so we'll let Spencer wrap things up.
Yeah, that's going to be it for us today. I hope you guys enjoyed. Gil and Rob there on the docket for tomorrow's show. We are joined by a pair of biotech experts, Jonathan Wexler and Paul Uke from LifeSci Capital. And then Bill Studebaker will join the show. He's with Robo Global as well. That'll be at 9 a.m. tomorrow. So that's our show for tomorrow. Hope you guys enjoyed today's show. Hope you have a good rest of your day. We'll see you folks tomorrow.